Hello and welcome to How to Invest. In today's video, we're going to be talking about Shift4, which is a payment processing company. We've talked about it on the channel before. I did a live stream where I deep dived. I listened to their whole 2025 Investor Day. If you want to go watch that, that's a really good place to start to do your own due diligence. So we'll have a link for that, but you can watch that after this video. We're going to be covering the Q3 earnings call in this video, just giving some updates and highlights from the shareholders letter and from the webcast. I highly recommend you go and listen to that yourself as well. A little bit about me. I am a stock analyst for a holding company with over $7 million of assets under management, as well as my own personal $100,000 portfolio. Quick disclosure, we are not certified financial advisors. This is not financial advice. All investments carry risk. You are solely responsible for your investments. We encourage everyone to do their own due diligence and research. We have a high risk tolerance and a long investment horizon. This video reflects our opinions only at the time of recording and are for educational and entertainment purposes only. Let's start with looking at the stock chart because the price is actually in a really interesting spot at the moment. If you look at this screenshot here, I have the price from the 31st of December 2020 highlighted and is actually at the same price it was trading for almost 5 years ago. And oftentimes at IPOs, stocks are very overpriced, but it is crazy to note the long base this has been forming. And what we love here at How to Invest are companies with super long bases where the stock price is either flat or down, while the fundamentals of the company have been improving dramatically. So that is what we're going to be looking at today, the fundamentals, the update on the fundamentals from this earnings call. And I just want to first start by pointing out this huge base this company has been building while its fundamentals have been improving quite rapidly. The new CEO, Taylor, just took over from Jared Isaacman, who was the original founder and CEO of Shift4 Payments. He just got nominated to run NASA, which we're super excited about. I think that's a win for everyone in the United States. But as shareholders in Shift4, obviously it's a bit of a bummer, but Taylor has been there since the beginning of the company as well, and he's also been working with Jared that entire time. So we believe in Taylor a ton. Jared is still the largest shareholder. He does not have to divest any of his shares, but actually there is a simplification in the stock structure. So Jared actually had super voting stocks. His stocks are now being turned back into just normal stocks that gives him the same voting right as everyone else. So it simplifies the stock structure a little bit. So that's a little nicer for shareholders. But to be completely honest, I'd still rather Jared have super votes because there's nothing that beats that founder mindset. And I'd probably just vote the direction he was going to vote anyways, because I trust him and I believe that he's an excellent leader of companies, as he's shown through his leadership in Shift4, building it to a multi-billion-dollar company. And so, there's good and bad. It simplifies the stock structure, which allows it to be added to certain ETFs that it wouldn't be allowed to be added to before with the two classes of shares. So that's an advantage, but we are kind of losing, Jared's really strong voting, which I think the way he would vote would probably be the best for companies and shareholders since his incentives are so aligned with ours, him being the largest shareholder. So he's still the largest shareholder. He's still on the board. Taylor is an excellent CEO. As well. He's been there for a long time. So no worries there, but just a little bit of background and context around that. So we're going to look at a couple excerpts from the shareholder letter, starting with this one, where the new CEO, Taylor, he said in the shareholder letter, he said more simply, these pages may look similar to prior quarters because this strategy is unchanged. Now, the strategy I'll go into a lot more here in a minute, which is their M&A strategy, mergers and acquisition, which is actually their main driver of growth, but we'll continue reading. The results of that strategy mean we are a higher quality and more diversified business than ever before. It is this improved business mix that helps us navigate a varied customer behaving differently across business verticals and geographies. That's basically just to say they're trading at the same price they were trading at in 2020 but the company is better and more diversified than it has ever been before. And just to hone that in a little bit more, they had these graphs in the Q3 earnings letter, and it just shows their vertical diversification and their geographic diversification. So you can see here in Q3 2024, they're very heavy in the Americas, which actually is a little bit misleading because you would think, oh, that's just the United States, but that's all of the Americas, which includes North and South America. They are in many geographies across North and South America, Canada, Mexico, United States, Argentina, Brazil, and so many more. So even just like the Americas being one block actually undermines the amount of diversification they have, because that's actually multiple countries across the Americas. But yeah, you can see Europe has become a lot bigger mix. I'm not exactly sure what ROWAPAC stands for, but they serve countries in Africa and Oceania, and in Asia as well. So I'm guessing that kind of includes those countries in that mix. So you can see the geographic diversification is increasing, and then their vertical diversification is increasing as well. So the big jump in luxury retail comes from their recent acquisition of Global Blue, which works with really big luxury retailers. But this just to point out that, again, trading at the same price as 2020, but much, much better business in terms of the fundamentals, in terms of diversification, and so on. So that was one big takeaway from the letter for me. The next big takeaway is this next little snippet from Taylor at the end of his shareholder letter. He said, "I will close by reminding you all that capital allocation is a core competency of our business. This forces us to prioritize where the next dollar is spent, and with urgency. As the free cash flow of the business improves each quarter, nothing has changed with regard to this philosophy. New products and geographies present themselves often. M&A opportunities come and go, and our own equity fluctuates, often as a result of what our competitors are doing as opposed to our results. To this end, our board has authorized a new $1 billion stock repurchase program, which is the largest in our history. I would recommend everyone who's watching this video to go purchase the book, The Outsiders. We're not affiliated with them at all. But in the book, they talk about what makes incredible CEOs and management teams of companies. And the biggest thing was their ability to allocate capital efficiently. And I think the Shift4 is a perfect example of an incredible board and C-suite that knows how to allocate capital incredibly efficiently. So either through M&A, so purchasing of businesses that directly influence the bottom line, and through things like stock repurchase programs, which can actually be very destructive to shareholder value if you don't understand the dislocation between inherent value of a company and the price it's trading at. So they're pointing out that currently the inherent value is far above the price that the company is trading for. So I think this shows great competency by management in their ability to allocate capital in a way that is accretive to shareholder value. So I just want to point this out. And I highly recommend listening to the book, The Outsiders. If you go listen to this book, you'll be like, wow. If you understand Shift4 and you listen to that book, you will see so many things that are so similar between the management of the books, the companies the book talks about, and what the management at Shift4 is doing. This next slide is just, again, more about why they are so good at allocating capital. Now, I've kind of condensed this into an actual flywheel that I want to show to you guys right now. This is a very simplified version of the Shift4 basically framework or flywheel on how they allocate capital in terms of mergers and acquisitions. Now, the share buyback program is another example of very good capital allocation, as there is a huge dislocation between the inherent value of the company and the share price it's trading for. But I want to explain their M&A flywheel, which is they buy a new company. So they have a very stringent underwriting that they do. A whole division of the company just exists to underwrite M&A like deals and what it means for Shift4. They buy a company, they acquire new products, through buying the company. They acquire new customers through buying the company. And sometimes these customers are very, very difficult to acquire. They have worked with certain vendors for a really, really long time. They're not willing to change vendors. So if you buy the vendor that's serving that customer, that's a really good way to get those customers without having to take them away from long-term relationships. You just buy the person that has the relationship. So it's not just you're buying the customer, you're buying the relationship with that customer that already exists as well. The new products, so you can develop new products, or if you want to add a new product to your platform, instead of spending all of the time it would take to develop that product, you just buy another company that's already spent the time buying that product, and you get the product right now. The other thing it does is it allows them to enter new geographies. So you get all the people who are already experts in working in that geography. You don't have to worry about hiring talent because you're buying the company that already has the talent for that geography. So this is what they're actually buying when they're buying a company. They buy the new products, the new customers, and the new geographies. This has been the main way that they have been growing. Now, after they buy the company and they acquire all those things, the next thing they do is they delete parts. You don't want to end up with 3 HR departments. So you get operational efficiency because you get all those customers, but now your overhead, your fixed costs is lower for those customers because you already have all those fixed costs as part of your core business. You delete parts in the product. So if there's a product that has the same features as a product you already have, you delete those and you merge those products into one massive platform, and you cross-sell. So you cross-sell through that improved single platform, which is oftentimes cheaper for the customer. Now, on top of deleting parts, I want to add one more piece there. They actually have a bounty for their employees. If bounties are able to bring a part to management that can be deleted, they literally have cash compensation for that. So this is the entire culture of Shift4, is deleting unnecessary parts. There's massive incentives around this, and it just allows them to have really good margins because you're not bringing all of this operational like fluff and they're very, very lean with their operation. And when they buy a company, they make sure to trim any operational fat unnecessary to continue to run that company. What this does through this cross-selling, through this operational efficiency of deleting parts, through this better platform for customers, it produces tons of free cash flow. And with that free cash flow, they buy another company. So this is the flywheel that they're creating with their M&A strategy. So very, very excellent strategy. And not only is it a great strategy that's brilliant, they also execute on it incredibly well. And they have a track record of executing on this very, very well. So this isn't just some new thing that they're doing, and who knows if they're going to be able to do it well. They've proven they've been able to do this well. They've proven that they've been able to, expand to new geographies, cross-sell to customers, improve their main product. They've proven that they've been able to delete parts, cut fats, remain lean, and they've proven that this whole thing just produces tons of free cash flow. So, all right, let's go back to the shareholder letter. All right, finally to some of the performance highlights of the third quarter, and then we'll give some more context to it in the broader picture and what that means for some potential returns. So payment volume was up 26% year over year. This is kind of like, this isn't what you should think of as the top line. The top line is really this gross revenue less network fees. So they have gross revenue, and then they have gross revenue less network fees because they have to pay network fees for some of this payment processing. So, the top line really is this gross revenue less network fees, and that was up 61% year over year. And that was mainly because of this Global Blue acquisition that they just completed. Now, 61%, it seems like a ton. I'm going to put that into some more context because they're guiding for 30% for the next 3 years. So I'll talk about that a bit more in a minute. But yeah, just an incredible quarter across the board, incredible results, 62% year over year gross profit. Everything just looks absolutely incredible. Now, let's talk about EBITDA, because this is insane, especially if you know what the rule of 40 is. Now, their EBITDA margin is 50%, and they are, guiding for 30% growth. And we'll talk about that growth a bit more in a minute, but that actually gives them a rule of 40 score of 80. So double the rule of 40. So absolutely incredible. anyone should be incredibly, at least intrigued by this rule of 40 score. I just thought this was an incredibly beautiful bar chart from the shareholder letter. This is exactly what you want to see for gross profit and, again, gross revenue less network fees. Basically, you just think of it as the typical revenue for a company, and that is up and to the right, just absolutely beautiful. The 4-year CAGR for gross profit, 63%, and the CAGR for gross revenue less network fees, 41%. So incredible track record, and why we believe so fervently in management's guidance of 30% growth for the next couple of years. So I know I've mentioned that a few times. Here's the free cash flow and the operating cash flow, both incredible as well. And we'll talk about the adjusted free cash flow a bit more because they have an incredible guidance for where that's going to be exiting 2027. So talking about that guidance, here it is. So their sit on the hands case, which you can think as kind of their organic growth. So what the core business is growing at without this continued M&A strategy. This is their guidance for that in the medium term, which I believe was through 2028, was high teens. So we'll see what the actual result is here in a second. This is from their 2025 Investor Day. So the impact of Global Blue. So this was before Global Blue acquisition was completed. They're saying with this Global Blue acquisition, the 3-year CAGR is 25% plus. Now, the most likely case, which is their acquisition of Global Blue, the organic core business growth plus continued M&A, which is their way of continuing to grow. So they said this is actually the most likely scenario. Their 3-year CAGR for revenue growth was 30%. So this is what we're going to use for our projections at the end of the video to kind of see what kind of returns we can expect. But yeah, absolutely incredible. And this is what we are actually seeing in terms of this latest quarter. So the organic core business growth was 18% year over year. With the Global Blue acquisition, it was up 61%. So now 61%, oh, but they're only projecting 30. This is an average. So, some quarters it's going to be up 61% because they recently did an acquisition, and some businesses are not going to be an acquisition, so it's just going to be the core organic growth. So 30% is the average CAGR, and they're continuing to do more M&A. They closed on SmartPay acquisition, and they announced an acquisition of Bombora. So they are continuing to do their M&A playbook, and they are continuing to grow organically very strongly. So I think this 30% CAGR is very, very reasonable, and the management even said themselves that this is the most likely scenario they're seeing. So I just want to make a quick little teaching point here about shareholder equity. This is from Macro Trends. And their shareholder equity after the close of the Global Blue acquisition shot up a ton. So this says they have $2.2 billion in shareholder equity, which is basically the same as net asset value. So basically just assets minus debt. But really quickly here, I want to go over to our spreadsheet because they have liabilities. This is from the latest Q3 earnings letter. They have liabilities of $6.7 billion of liabilities. But they actually only have assets of 6.5 billion, and that's after you eliminate goodwill of 2.5 billion of goodwill. So after you buy a company, you typically add goodwill on it, but we remove goodwill, and this is why. Because goodwill, it represents the non-physical assets such as the value created by a solid customer base, brand recognition, or excellence of management. Business goodwill is usually associated with business acquisitions. Goodwill cannot pay debt. It is not a real asset. So we like to eliminate it. So this is probably the biggest thing or biggest negative for Shift4, in my opinion, is they actually do have a negative asset value. They currently do have more debt, but management has a very, very strict leverage guideline that they are still adhering to. They are not above their internal leverage guideline. And they are just producing so much free cash flow. They did not seem concerned about this at all. So, but just a little teaching point on goodwill. When you're looking at enterprise value or the net asset value of a company, it is a really good idea to back out goodwill because, in our opinion, that is not a real asset. So it can materialize as revenue in the future through the cross-selling or because it's business relationships and stuff. So it can actually produce revenue in the future, but I would leave that to the future to decide whether or not that is really something that should be considered when you're talking about, buying a business, a company, a stock. So just a little teaching point there. Um, Now, this is another teaching point because we just talked about what the management guidance is, that 30% compounded annual growth rate for revenue. I just was on Yahoo Finance and I was looking at this and I could not believe it because this is what analysts are trying to say the current year revenue growth for Shift4 is going to be. They're saying 26% this year and 24% next year. They do not believe in Shift4 whatsoever, even though the management has consistently shown they're able to execute. So this is actually what management is saying the year-over-year growth rate for 2025 is going to be 46 to 49%. So this is why it's so important to not just listen to what analysts on Wall Street are saying. You need to do your own research. And I love this quote from Peter Lynch. He says, "Dumb money is only dumb money when it listens to smart money." I think those are the opening words from this book. I highly recommend you go read it. If it was not this book, it was another one. But this is our favorite book by Peter Lynch. He's a mentor and has taught us most of what we know and most of our framework for how we go about investing. But I just really wanted to point out that huge dislocation between what is actually happening in the business and what analysts are saying is happening in the business. So now let's talk about potential returns from here. So this is from their 2025 Investor Day, and they're talking about exiting 2027 with a free cash flow run rate of $1 billion. So that is in 2 years from now. So if you slap a 20 times price to free cash flow on that, that means that the price should 3x within 3 years, which is not unreasonable. Meta is trading at like 40 or something. So 20 to 30 is pretty reasonable for most businesses, and especially a business like Shift4, which will be exiting this period with, around 30% revenue growth. So it could be even higher multiple, deserves even higher multiple than that. But if you put a 30 times free cash flow on it, it should 5x within the next 3 years. And we'll also show our modeling as well. So, and on top of that, so that's from the Shareholder Investor Day at the beginning of 2025. This quarter, they said they're on pace to exceed the $1 billion 2027 exit rate guidance. So they are actually going to exceed that based on what they're currently seeing as of Q3 2025. So now let's move on to what we expect in terms of ROI, in terms of purchasing stocks of Shift4. We'll go look at our assumptions real quick. So these are assumptions. So 30% over the next year, the year after that, and the year after that, which is based on their 3-year guidance of 30% revenue growth. And then we're assuming a little bit of revenue deceleration from 30% down to 15% by year 10. So that is actually a lower rate than their current organic growth in 10 years of 18% during this quarter. Plus, they're going to continue to do their M&A strategy. So you're starting to get to the law of large numbers where it just continues to become harder and harder, but you still have companies like Meta growing their top line by 20%. It's absolutely crazy. So I think these could be potentially conservative, but we think that this is a decent likelihood of happening. And again, our modeling is more about being directionally correct than being, it's not going to be actually correct. So directionally, we think the 5-year inherent value is about 4.2 times higher than the current stock price. And we think the 10-year inherent value is going to be here on this bar chart, 12.7 times, which is basically in line with our 30% compounded annual growth rate CAGR benchmark. So we think this is an excellent company. We highly recommend you go do your own research if you're interested based off of this video. It is currently our 3rd largest position here at How to Invest. So thank you so much for watching. I hope you learned a lot, not just about Shift4 and their latest earnings call and shareholder letter, but about how to invest in general. I hope you enjoyed. Make sure to hit like and subscribe for more coverage like this in the future.